Hey guys, welcome back to the channel. You know who it is. So we're going to be talking about something that I haven't seen too many videos here on YouTube, certainly not in the way that I would like them to be shot or like them to be explained. So I'm going to do my best today to break down the idea of risk versus reward in simple, plain to understand English, and it is for everybody that's based here in the UK. There's tons of people, who are US, American creators talking about this kind of stuff. But right now at home, I want to talk about this specifically and break this down in simple terms so it's easy for everybody to understand. If you are new to this channel, this is the first time you're finding a video of mine, thank you so much for clicking on. You want to subscribe to this channel, smash the like button. I talk a lot about investing. I'm a qualified financial advisor. I've been in the industry for 15 years. I'm not advising currently. I've worked for investment houses. I've done quite a lot through my career, and this is really where my expertise lies. I've been in wealth management, talking about investments and working with investments for the last 8 years. So if you've not subscribed, smash the like button and subscribe. You will not be disappointed by following me. So without further ado, I'm going to keep this really, really simple. I'm not going to use complicated language. I'm not going to be talking about alpha or beta or R squares or anything like that. I'm going to break it down very, very simple so that you can understand the correlation between the risk that you're willing to take and the reward that you're hoping for, whether you're doing it by yourself, especially if you're doing it by yourself with Trading 212 or Free Trade, or whether you're using Moneybox, Wealthify, or someone like that who's going to be doing this work for you. I always say, even if you are outsourcing this stuff, you need to understand how these things work so you have the confidence in knowing what they're doing behind the scenes. So let's go and get into the weeds of this. Risk is a fundamental aspect of investing that you have to accept when you're putting money into anything, right? It comes with the territory. You cannot expect to accumulate wealth without taking on some kind of risk. The key is that whenever we talk about investing, we never invest by taking wild risks. The risks are always calculated, they are measured, they are as known as we possibly can get them to be known. We never guess. We just don't walk into a casino, put all of your money on black and hope for the best. That's not how this works. We take calculated risks, well-informed risks. And in order for you to do that, you have to understand what risk basically is and how you can use different instruments when you're investing to help you manage your risk. And this is the stuff that I want to explain in today's video so that if you are using Trading 212, you have the full heads up of what's going on and the things that you need to be considering. I've spoken previously in one of my other videos, I'm going to tag this right here, that one of the things that you really need to do if you're looking at using Trading 212 or Free Trade is you need to know how to diversify your portfolio. Now, that can be very, very hard to do because in the world of investing, using Trading 212 gives you exposure to only one kind of asset class. And I'm going to talk about what asset classes are as we go through the rest of this video, so bear with me. An asset class essentially is a basket. So I often talk about putting all of your eggs in one basket. Well, using Trading 212 puts all of your eggs in one basket, the equity basket. So it's really important for you to understand how you spread your eggs across a number of different baskets to ensure that you're minimizing your risk as much as possible. Now, again, if you're using Trading 212, you are overextending yourself. You're putting all your eggs in one basket, but you can still diversify within that basket. And in that video, again, I'm going to tag it here. I explain how you begin to actually do that. So with this is all about foundational knowledge, and I think it's very, 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 very important. Yes, everybody wants to use Trading 212. Everybody wants to have control of their own destinies, but I believe that it's really, really dangerous if you don't understand how the fundamentals of these things work. Now, a lot of the stuff I'm going to be talking through in this video are kind of very small snippets from my investment course. So if you've not looked at my investment course, it is an investment of money that is going to give you the full picture, not just risk. It talks about investor psychology. It talks about your taxes, what taxes you have to pay, your tax allowances, the things you have to do, the things that you need to consider if you are using Trading 212 and you're picking stocks. How do you do basic research? What questions do you need to ask yourself to inform your research? It is a very worthwhile investment at $99.99. Trust me, this thing will put you in the best position possible so you understand what's going on. So a lot of stuff I'm going to be talking about today is going to be excerpts from that. It's going to give you a very brief view of the risk module that we cover in that course. So oftentimes when I work with people, I'll ask them, right, so on a scale of 1 to 10, what risk level are you? Most people will come out or think they come out at the higher scale of a 10, right? However, you need to understand that when you're investing, the key question that you need to be asking yourself is, what risk are you able to take? Not what risk are you willing to take, what risk are you able to take? Now, let me tell you how you define what risk you are able to take. It's really important that you take a step backwards. Let's just say you have £1,000 that you want to invest and you've decided that you want to put it into a Trading 212 portfolio. You've identified maybe 4, 5, 10, 12 stocks that you're going to split the money across, okay? The first thing you need to be looking at is, okay, how much risk am I able to take in this position? And the first thing you need to look at is, number one, are you in a sound place financially? What I mean by that is, not are you earning, £15,000, £20,000 a month. That's completely irrelevant, all right? If you are, that's perfect. But this question would still apply even if you are. Are you in a good place financially where you know that you have X amount coming in, you have X amount going out, and the money that you're investing is essentially your discretionary income, so it's surplus to requirements? That is a fundamentally important question. If the answer to that is no, you've got money coming in, money going out, and you've got very, very little or next to nothing left in a discretionary pot of income that you don't need, and that's, why you're investing, then I would argue to say that if you put yourself at a scale of 10, you're probably going to be in the region of a 3 or a 4 in terms of the risk that you are able to take. Remember, your initial inclination of where you are on a 1 to 10 is essentially the risk that you are willing to take. The risk that you're able to take is more practical, it's more pragmatic, it looks at the reality of how you are managing your finances right now. So key question, are you in a good place financially? Do you have surplus income? If the answer is yes, then fine. The risk that you're willing to take could be a 9 or a 10 if that's where you scored yourself. The second thing that you need to ask in order to gauge where you are in terms of the risk that you're able to take when you're looking to invest in the market is, you need to ask yourself this very fundamental question. Do you have enough money set aside so that if you were to lose your job or COVID-19 were to happen again, that you know that your bills are going to be covered for at least 6 months? At least 6 months. This is called an emergency fund. So with an emergency fund, it covers all of your essential outgoings, your rent, your mortgage, your gas, your electric, your council tax, all of your essential bills that you have to pay. It will also include things like your credit commitments, so personal loans, credit cards, overdrafts as well. Do you have enough money to cover you should you lose your job in the next 6 months for that? Again, if the answer to that is no, then you cannot be a 10. You have to reel it back, and you're probably going to be around about a 3 or a 4, a 5 if you're lucky. So those are two fundamental things that you absolutely have to ask yourself before you begin investing. So the idea of investing versus time is essentially the idea that depending on how long you're going to invest for, then your level of risk or the level of risk that you take will be dictated by that duration. So for example, this is a slide from within my investment course, and this basically shows that the longer you have in terms of your investment time horizon, the more risk you can afford to take. The shorter the time you have, then the less risk you can afford to take. So for example, if you are investing for 3 years, you should not be taking the same level of risk that you will be taking if you're investing for 10 or 15 years. Why? Because you're probably going to need your money back out in 3 years' time. And this is particularly important if you are investing into something like a lifetime ISA, and you're going to need your money for a house deposit in X amount of years' time. You have to think very, very careful about the level of risk that you are willing to take and the risk that you are able to take. Now, let's bring this into the equation of using trading 212. Now, most people are using trading 212 and free trade to buy individual stocks into companies. So one of the most popular ones that I often talk about is Tesla, right? I love Tesla. Now, just because the share price of Tesla has been going up and it's reached all kind of record highs over the last week, does not mean that they're going to be a safe company. So in the instance where you're investing your LISA money into a company specifically, then what are the things that you should be looking for? You should be looking for stable companies that have been around for a while, preferably companies that have been paying dividends, because a company that pays dividends from profits, which means they have a pretty strong balance sheet. So you would be looking at the big companies, the Coca-Colas of this world, maybe the Walt Disneys of this world as well, Apples, for example. Those are the companies you'll be looking at because they give you a little bit more security than, say, someone like Tesla, who currently is not paying dividends, although we're seeing the share price go really crazy over the last week or so. Coca-Cola, Walt Disney are more stable than a company like Tesla because they've been around for much longer. So your selection of the company that you invest in is absolutely crucial in this equation. So the longer the term you have, the more risk you can afford to take. The less your term is, the less risk you should be taking. I'm going to reference back to the phrase asset classes. Remember, I likened an asset class or asset classes to baskets. Now, it's the same old saying, never put your eggs all in one basket. So essentially what you're trying to do when you're investing in the market is you're trying to look for a number of baskets where you can invest money to give you a return. Now, typically speaking, this is what the industry will always do. So I've been a financial advisor before. When we were building portfolios for clients, we would use a number of asset classes or baskets. And I'm going to explain what these baskets are and what they're there to do. And by me explaining this, you will understand exactly how you invest in the markets, knowing that you're taking as calculated a risk as you possibly can. Again, this is not a casino. Professional investors do not invest by guessing and thinking, right, Tesla, money all in is gonna work out fine. No, they don't. They understand the financials behind Tesla. They understand what the business does. They will probably sit down with Elon himself, these big investment houses, because guess what? They have a lot of money, and they'll be talking to Elon about the plans for the business. They will be privy to information that you and I will never have access to because we don't have the kind of scale and clout that they do in managing millions and billions and sometimes trillions of pounds for their clients. So they kind of have an inside track. So for you as a retail investor, how do you go about making sure that you are able to manage your risk as best as you possibly can in terms of the principles that you can actually deploy? So asset classes, baskets, let's talk about the different baskets. So we already know one basket clearly, and that is the equity basket. If you're investing with Trading 212 or free trade, you're all in on that basket right now, buying companies. Now, equities are simply just shares in companies. That's all it basically is. In exchange for your money, you own a piece of Tesla, you own a piece of Apple, you own a piece of Facebook, so on and so forth, right? So that is one basket. You have your equity basket. Now, typically, equities, you hear these phrases all the time, have returned great in the long term. They always do, in the region of around about 10 to 12% over the last 10, 15 years, right? This is where you're going to see the majority of your growth when you invest in the market, which is why they are so attractive. However, with your equities, because you've got all of your eggs in one basket and there are so many things that can impact the equity market. So you talk about volatility, for example. And what I'm going to do right now is I'm just going to highlight what that looks like using my Trading 212 account. So you guys can get an idea of what I mean by volatility and how devastating volatility can be sometimes when you're invested in the market. So let's just jump into my Trading 212 account. What I want to do here is just pick like a stock that has had its price go up and down quite a bit, because it will be a nice illustration of how volatility basically works. Now let's have a look at Facebook. As we can see here, if you go back 3 months, the price of Facebook has been quite volatile over this period of time. And we just look at it here. If you go back to the 8th of June, $228. Then we go down here to the 10th of June, $224. Then it goes up. Then there's quite a big dip down here on the 25th of June, which is literally 2 weeks later, $216. And this will happen almost daily. So let's just go daily here. So what we're seeing in this example is, this is just a 1 day view. So on Monday, the 24th of August at 14:35, it was $276. Then we saw 24th, 14:50, 272, right? I mean, this is within the same day, 271. Then we see it come all the way down here to 269. This represents volatility, and volatility is the idea that share prices will go up and down all of the time. So when you're exposed to equity specifically, this is what you've got to deal with, and this is the risk that you're taking, and the fact that if you put all your eggs in one basket, you may have 5, 6, 7, 8, 9, 10 companies in there. This is going to be happening to each of those companies every single day. So the idea is you have a counterbalance to use. So what the professionals will use is they will use things like bonds, and this will be your second basket. So remember, equities is one basket, your bonds will be a second basket. And essentially a bond is where you're lending money to a business or to a government. And essentially what they're doing is they're saying, look, if you give me £10,000, I'll give you a 5% return every single year for the next 3 years. So you know that in exchange for you giving them £10,000, you're going to get back your capital in 3 years' time, plus a 15% profit. And that is known from day one. That is a beautiful way of investing money, knowing that, if you've got a goal, and I talk a lot about goals, I always come back to this, guys. If you're talking about goals, right, my goal is I want to have a return of 6 or 7% each year. You know that you're going to get 5% from using basket number 2, which is essentially your bonds. Now, there are about 4 or 5 baskets that I typically talk about. I'm only going to highlight these 2 for this video because I think this will give you a really good contrast between equities, bonds, what they basically do, and how they can be used to manage your risk. So essentially in equities, you have no known outcome. They will do what they will do. Hopefully you're going to get a really good return in here, because really that's where the most of your growth is going to happen. However, in basket B here, which is basically your bonds, you have a known outcome from day one. And this means that you are able to tip the balance of this risk versus reward in your favor, knowing that you've got a bond here that's going to be kicking out 5% every single year for 3 years. And hopefully you're going to get a 5% return, a 7% return, or a 10% return from your equities basket. These are just 2 things you can use to ensure that you're managing your risk. Now, if you're using Trading 212, you're not going to have access to basket B, which is why I'm a firm believer, and I've said this before even on my lives, that if you're a first-time investor, most first-time investors will be better off using the services of someone like Moneybox or Wealthify or Nutmeg or someone like that, because they will do all of this work for you. They will select the right bonds, they will select the right companies. So a lot of people are arguing, saying, well, I want to know that they're going to be invested in Tesla. most of the big investment houses, including, Wealthify and Moneybox and Nutmeg and Plum and Wombat and all these guys, will have holdings in people like Apple, in Facebook, in Microsoft, possibly in Tesla. But you can ask this question and see whether they actually tell you. You can ask, do you hold Tesla? They will tell you. And it's really, really important that you understand that, whenever you're investing money, you have to think of it on a risk basis, but not the risk that you're willing to take, it's the risk that you are able to take. This is extremely important, guys. So look, there is more of this in the investment course. Again, if you've not taken it, it is a small investment for you. There is a link in the description. Go take it. It's 4 chapters, 15 lessons, completion in around about 96 minutes or so. It will give you all the basic foundations that you have. I have worksheets in there as well that you complete. You can complete it in your own time. So you haven't got to sit it all in one go. You can log out, come back in and do it as you please. But that's just a little taster. I wanted to break down risk versus reward very, very simply for you guys to understand that this is not about just pie in the sky, guessing what's going to happen. It is taking a calculated risk and trying to stack the odds in your favor so you do not lose money on your investments. Now, if you're using Trading 212 free trade, it can be very, very difficult, but just by understanding the concepts of asset classes and baskets, hopefully now you have a good idea of, right, this one would do this and it gives me a known outcome. This is where I get majority of my growth. And I'm sure that if you've watched this to this point, you have some questions. So leave them in the comments below. As you know, I always, always, always answer all of my comments, all of the questions that I get in the comment section. So let's have a discussion there. How are you managing risk within your portfolio? And guys, if you're not listening to my podcast, that is the artwork right there. Go check it out. I don't talk exclusively about investing there, but we talk about all things money and finance. It's fantastic. If you want to work with me one-on-one or want to book a troubleshooting call, I'm doing those now. So it's for people who have specific questions, who want to learn about something very, very specifically and need my expertise. You can also book that. I will leave a link in the description as well. But guys, let's have a conversation in the comments box until Friday. And by the way, if you've not taken part in the competition, go watch the video from last Friday. I'm giving away £100 to one of my lucky subscribers here. So go review that video and make sure that you enter. There are rules. Read the description box of that video for the rules. And I'll be announcing the winner to this competition, to this giveaway on Friday this week. So thanks so much, guys. Catch you later on.